It's early morning, still dark outside, the kind of quiet hour when the world isn't tea watching, and that, as usually, when the biggest changes slip through unnoticed. For the last several hours, I've been deep inside a document almost no one is talking about. It wasn't trending. It didn't make headlines. It didn't flash across financial TV. But it should have. Because buried inside this regulatory release is a rule change that quietly reshapes how the global banking system treats gold and silver for the first time in more than half a century. And it takes effect immediately, not next year, not sometime after review. Now, this isn't a theory. It isn't speculation. It isn't a trade idea. It's a rulebook change, and the kind banks don't get to ignore. To understand why this matters, we need to step back for a moment. At the top of the global financial hierarchy sits an institution most people have never heard of. It doesn't run ads, it doesn't give press conferences, it doesn't answer to voters, but every major central bank answers to it. The Bank for International Settlements. Think of it as the referee of global banking. When it rewrites the rules, banks around the world adjust, whether they like it or not. After the 2008 financial crisis nearly brought the system down, regulators reached a blunt conclusion. Banks were too leveraged, too fragile, and too dependent on assets that disappeared when stress arrived. So the BIS began rebuilding the rulebook from the ground up. That process unfolded slowly, in stages, over more than a decade. And now, with the final phase in place, the framework is complete. Here's the part that changes everything. Under the new standards, physical gold and silver, real metal properly stored and fully owned, are no longer treated like speculative commodities. They are elevated. They now sit alongside cash and government bonds as top-tier balance sheet assets. That's not a slogan. That's a regulatory classification. What does that mean in plain language? It means a bank that holds properly audited, fully allocated physical metal can use it to strengthen its core capital position. It improves their ratios. It reduces regulatory pressure. It makes the institution look safer on paper, which is exactly what regulators want. But there's a catch. Paper claims don't count. Unallocated metal doesn't count. Derivatives don't count. Only real physical metal with clear ownership stored in approved vaults, inspected, audited, and uncontested. That single distinction is where the pressure builds. Because for decades, banks and financial institutions relied heavily on paper exposure to precious metals. Contracts, promises, and synthetic instruments that required very little physical backing, those structures worked as long as metal stayed categorized as a secondary higher-risk asset. Now it isn't, and that forces a decision. Either banks acquire real metal, or they lose a capital advantage they can no longer afford to give up. This isn't about investor sentiment. It isn't about geopolitical fear. It isn't about industrial demand forecasts. It's about compliance. When regulators change what strengthens a balance sheet, banks respond, not emotionally, but mechanically, and mechanics move markets. This shift also changes something else that rarely gets discussed: the economics of excessive paper exposure. When physical metal becomes capital efficient and paper exposure doesn't, the incentives flip. Structures that once made sense suddenly don't. Positions that were cheap to maintain become expensive to justify. That's how long-standing distortions unwind, not through headlines, but through math. None of this guarantees prices. No rulebook ever does. But it does change the plumbing of the system, and when the plumbing changes, the flow changes with it. That's why this moment matters. Not because it's dramatic, not because it's loud, but because it's structural. These are the kinds of shifts that don't announce themselves. Years later, everyone points back and says, that was the turning point. And it started quietly. In a document most people never read, do you see what the rule is really saying? It's not subtle. From this point forward, if a bank has sold gold or silver it doesn't actually own, if it is betting against metal, regulators now demand something in return. Real capital, not a token buffer, not a rounding error, meaningful capital. The kind banks guard closely, and if they don't put that capital up, regulators have teeth. Dividend payments can be limited. Executive bonuses can be cut. Oversight tightens fast. That alone changes the calculation. Because short positions aren't free opinions. They now come with a carrying cost that eats directly into shareholder returns. Think about it from the bank's point of view. If you tie up hundreds of millions of dollars in top quality capital just to keep a position open, capital that could otherwise be deployed into lending fees or low risk yield, that position has to earn its keep. And most short trades in precious metals simply don't. They generate thin margins, sporadic gains, and long periods of dead money. Once the cost of capital is applied honestly, the math stops working. So the rational move isn't clever, it's obvious. You unwind the short, you free the capital, you move on. That's not ideology, that's balance sheet logic. And this isn't hypothetical. Ahead of the rule change, we're already seeing positions quietly disappear. Open interest has been shrinking. Not because investors lost interest, but because institutions are stepping away from exposure. They no longer want to carry under the new framework. No speeches, no announcements, just exits. But here's the risk in waiting. When too many players try to leave the same door at the same time, prices don't rise politely. They gap. That's not speculation. That's mechanics. And this isn't driven by retail traders or momentum chasers. It's driven by compliance schedules and capital math. Banks aren't choosing timing. The calendar is choosing for them. Now, there's a transition window. Regulators aren't demanding perfection overnight, but they are demanding progress. Banks must show they're moving in the right direction, steadily, measurably, and soon. Missed those milestones and scrutiny ramps up fast, which creates a second pressure point. Institutions now have a limited window to either convert exposure into properly backed physical holdings or reduce exposure entirely. Both paths require action. Neither allows complacency. And here's where reality intrudes. Physical metal doesn't appear on demand. The global supply of gold and silver is already spoken for. Mines, industrial users, long-term contracts, mints, reserves. What actually trades freely is a thin slice of the total market. So when large institutions need size, real size, they don't get it quietly. They compete. And competition in a tight physical market doesn't resolve sideways. It resolves through price. This is why the next phase isn't about forecasts or opinions. It's about throughput. How much metal can realistically be sourced? How quickly and at what cost? When regulatory deadlines collide with physical limits, something has to give. That's the real story here. Not panic, not hype, not a sudden awakening. Just a rule change that rewires incentives and forces action in a market that doesn't have much slack left. And once that process starts, it doesn't need belief to continue. It runs on necessity. Read this carefully because this is where the pressure actually shows up. From this point forward, a bank can no longer be casually short gold or silver. If they've sold metal they don't physically own, regulators now require them to lock up real capital against that bet. Not symbolic capital, not accounting tricks. Actual top-tier capital, the kind that belongs to shareholders. And if a bank refuses or drags its feet, regulators don't argue. They restrict dividends. They cut off executive bonuses. They tighten supervision. That's the language banks understand. This single change breaks the economics of naked short selling. Why? Because shorting precious metals was never a high-return business to begin with. It worked only because it was cheap to maintain. Once that changes, the trade collapses under its own weight. Think about the math from a boardroom perspective. If a bank has a large short position in silver, the new framework forces it to reserve a meaningful chunk of its best capital just to keep that position open. That capital isn't free, it's equity. It carries expectations. Shareholders want it earning solid returns, not sitting idle supporting a low-margin trade. When you tie up hundreds of millions of dollars in capital to chase a modest trading gain, the return on equity becomes embarrassing. Single digit, sometimes worse. That's how careers end. So the response isn't ideological, it's practical. You close the short, you release the capital, you redeploy it somewhere that won't attract regulatory heat. And that process doesn't wait for headlines. It happens quietly, before deadlines, while prices still look manageable. That's why we're already seeing positions disappear. Exposure is shrinking, not because belief has changed, but because the rules have. But here's the trap many institutions face. They all see the same deadline. They all see the same math. And many of them wait, hoping someone else moves first. That never ends well. When too many shorts try to exit at once, prices don't drift upward. They jump. Liquidity vanishes. The exit narrows. That's what a short squeeze really is. Not hype, not retail frenzy, but forced buying driven by structural necessity. And this one isn't optional. Banks don't get to sit it out. If they don't act, the penalties escalate automatically. Compliance isn't a suggestion, it's enforced on a schedule. Now, regulators did allow a transition window. Banks aren't required to be perfect overnight, but they are required to show progress quickly. Miss early benchmarks and oversight tightens, miss final deadlines, and the consequences become very real, which creates a countdown. Institutions now have a limited number of weeks to either replace paper exposure with properly backed physical holdings or reduce exposure altogether. Both options require action. Neither allows delay. And this is where the physical market becomes the bottleneck. Gold and silver aren't software. You can't spin them up on demand. Supply is already allocated. Mines, industrial use, long-term contracts, reserves. What's actually available to buy in size is thin. So when large institutions need real metal, they're not shopping, they're competing. And competition in a tight market doesn't resolve politely. That's the real tension here. Not opinions, not predictions, not sentiment. A regulatory clock is now ticking against a market that doesn't how IT have the depth to absorb rush demand quietly. That's how pressure builds in financial systems. Slowly at first, then all at once. Under the new framework, banks don't get to sit in the middle anymore. Exposure that isn't backed by real metal has to change form or disappear. In practice, that means two things happen at once. Some positions get shut down entirely. Others are converted into fully backed physical holdings. Even if you assume only a portion gets converted, the amount of metal required is enormous by historical standards. And this is where the numbers stop being abstract. The physical gold and silver markets are not built to absorb sudden, large institutional demand. Annual mine supply sounds big until you break it down into what is actually available at any given moment. After industrial use, long-term contracts, and existing obligations are met, banks can't simply order metal the way they order software licenses. What's left over for discretionary buying is thin, fragmented, and slow-moving. So when institutions assuredly need metal within a fixed window, not because they want to speculate, but because they must comply, the constraint becomes obvious. There isn't enough supply at current prices. Markets resolve that kind of imbalance the same way they always have, not through negotiations or forecasts, but through price. Price rises until holders are willing to part with inventory. Price rises until marginal demand backs away. Price rises until a new equilibrium is forced into existence. That's not a prediction. That's how physical markets clear when demand runs ahead of availability. And importantly, this demand is inelastic. Banks can't wait it out. They can't watch and see. The clock is set by regulation, not sentiment, which means adjustment happens on the market's terms, not theirs. Now, this shift doesn't stop with banks. It flows downstream to anyone holding precious metals through the banking system, especially through unallocated accounts. Under the updated rules, those structures become expensive for banks to maintain. They consume capital without providing regulatory benefit, so institutions are being pushed to restructure them. What that means for account holders is simple. Change is coming. Clients holding metal, claims that aren't specifically allocated and segregated, will be contacted and given choices. The details vary by institution, but the options follow the same logic. One option is to convert to fully allocated storage. Real metal held in your name with transparent custody that preserves metal exposure, but it comes with explicit storage and administration costs. Another option is to exit entirely, close the position, and receive cash at market value. Clean, simple, but it ends metal exposure and moves everything back into currency. The third option is usually some form of conversion into a bank-issued instrument, effectively turning a metal claim into a promise backed by the bank itself. That last option changes the nature of what you own. You're no longer holding metal exposure, you're holding credit exposure. If the institution runs into trouble, you stand in line with other unsecured creditors. That distinction matters. This is not about fear or urgency, it's about structure. The rules are reshaping incentives for banks first, and then for customers connected to them. Paper convenience is being replaced with physical accountability, and anything that doesn't fit that model becomes more expensive to keep alive. That's how regulatory shifts work. Quietly, methodically, and with consequences that ripple outward over time. Not everything breaks at once, but nothing stays the same. If you're holding precious metals through an unallocated account, this is the moment where inaction stops being neutral. Those accounts are built on promises, not possession. Under the new framework, banks are being pushed to unwind that model, and that means account holders are going to be asked to choose what they actually want to own. When those notices arrive, and many will, people will realize in something uncomfortable. They didn't own metal. They owned a claim. For some, that realization will be jarring. For others, it will prompt immediate action, and that reaction matters. Because when even a fraction of those holders decide they want real allocation, metal held in their name, not pooled on a balance sheet, banks have to source it, not symbolically, physically. That creates a second wave of demand that has nothing to do with investors chasing price and everything, to do with people trying to convert promises into ownership. At the same time, banks themselves face another constraint. To acquire large quantities of physical metal, they don't conjure money out of thin air. They raise cash the same way they always do, by selling other assets. And those assets are overwhelmingly dollar-denominated. Government bonds, corporate debt, sometimes equities. That shift matters at the system level. When large institutions reduce bond holdings, yields rise. When demand for dollars softens, currencies weaken. When credit tightens, economic activity slows. None of this happens in isolation. It's unfolding alongside already visible pressures, slower growth, stubborn inflation, geopolitical uncertainty, and a central banking system with limited room to maneuver. Together, those forces, Dante, point to a clean expansion or a clean recession. They point to an environment where financial assets struggle and tangible assets gain relevance. That's the broader backdrop. What's important to understand is that this isn't a grassroots market move. It isn't driven by sentiment or speculation. It is being pushed by regulation and by rules that change what banks are rewarded for holding and punished for avoiding. And regulatory pressure tends to move slowly at first, then very quickly. So what does that mean in practical terms? It means understanding what you actually own, how it's structured, and where counterparty risk sits. It means paying attention to how institutions respond, not to headlines, but to policy changes. And it means being prepared for volatility as the system adjusts. The next several weeks are unlikely to be smooth. Prices may move sharply in both directions as positions are closed, converted, or restructured. That kind of movement doesn't indicate chaos. It indicates transition. The key isn't reacting to every price swing. It's recognizing the underlying driver. This shift isn't emotional. It isn't narrative-based. It's mechanical. When rules change, incentives change. When incentives change, capital moves. Quietly at first, then all at once. And once that process starts, it tends to run its course, whether markets feel ready for it or not. The fundamental reality is straightforward. Supply cannot keep up with the new demand the rules create. Banks now have a legal and regulatory incentive to hold physical gold and silver. Paper positions, previously common, are no longer efficient. Naked short selling is no longer viable. And over the next few months, banks will need to acquire quantities of metal that far exceed what the market normally provides. This is not speculation. It is the direct result of a structural change in the banking system. Starting January 13, 2026, the Basel III Endgame rules come into effect. Gold and silver are now treated as Tier 1 capital, the same classification as cash or government bonds. Banks are rewarded for holding physical metal and penalized for holding paper. The system itself has changed. For the first time in more than 5 decades, precious metals are being quietly remonetized. Since 1971, they have been treated largely as commodities, speculative assets, or relics of the past. That era ends now, not through headlines or policy speeches, but through incentives embedded directly into banking regulations. The implications are profound. Banks are moving to cover short positions, to acquire physical holdings, and to comply with Tier 1 capital requirements. The physical market, which is already limited, is now facing a surge of demand from institutions that must act. Prices will respond, not because of speculation or hype, but because of the mechanics of supply and compliance. This is the largest structural shift in the precious metals market in half a century. Most people will not notice it as it begins. Media coverage is minimal, but the banks understand, and the market is already adjusting. Over the coming weeks, allocation will matter more than claims. Physical metal will matter more than paper, and the balance sheets of major banks will be reshaped. The rules have flipped the incentive structure in favor of physical ownership. This is a moment where understanding the system and positioning thoughtfully is more important than trying to predict price movements. The Basel III Endgame is here. The framework that governs global banking just changed, and with it, the role of gold and silver in the financial system has changed too. What happens next will unfold in the market quietly at first, but its effects will be far-reaching.